Welcome to the PAI Morning Briefing. I'm your host from Pantheon AI, and today is February 10th, 2025. Good morning, everyone. I hope you're as energized as I am because we've got an action-packed day ahead. Before we jump into our deep market discussion, let's take a quick look at the numbers that are setting the tone for the day. The S&P 500 is trading at approximately 6,054.1, with a modest gain of roughly 0.127%. Over in the Dow Jones, we see it sitting comfortably at around 44,437.8, up by about 0.092%. Meanwhile, the Nasdaq is at roughly 19,687.2, moving up a neat 0.097%.
Not to be overlooked, the Russell 2000 is showing a slight hiccup with a decline of approximately negative 0.25% at about 2,283.6. And for those following the digital asset markets, Bitcoin is trading at around $97,347, making a healthy move upward by almost 0.89%, while Ethereum is close behind at about $2,651, increasing by a similar margin of nearly 0.88%.
Now let's shift gears and talk trends. One of the hot topics this morning is the reaction of U.S. stocks to the weekend tariff news. Over the weekend, there was some chatter in the corridors of power regarding a potential 25% tariff on all aluminum and steel imports. President Trump has been signaling that he intends to impose reciprocal tariffs on all countries by later this week, potentially Tuesday or Wednesday. Although the markets initially hesitated and weighed the implications of such a hefty tariff move, the overall sentiment seems to be one of cautious optimism as traders adjust to this new rhythm. I must confess there's a bit of irony here. While tariffs may be designed to protect domestic industries, they can also introduce volatility. It's a bit like putting a speed bump on a highway. You know it'll slow you down eventually, but sometimes the surprise of it just makes you jump a little too high.
And as investors, we need to be ready to navigate those bumps with both caution and a pinch of humor.
Speaking of bumps, let's talk about some of the key stories making headlines. First up, we have the quantifiable evidence that steel stocks are cheering the tariff news. Domestic producers see President Trump's move as a strong stance against what they call unfairly priced imports. Companies like Nucor have already shown an uptick in their share prices, reacting positively to this promise of a more level playing field. And while that might sound like a win for the steel industry, it does raise questions about broader economic implications. Will these tariffs eventually lead to higher costs for downstream industries, or could they signal a broader rebalancing of global trade? There's an interesting debate brewing here, one that asks us to consider whether protectionist measures ultimately build a nation's strength or merely slow down the gears of globalization.
We also have the story of Schwab buying back a significant chunk of its own stock, even after dipping into a sizable buyback program totaling $1.5 billion. This move comes alongside TD Bank's decision to sell its 10% stake in Schwab, which will soon be followed by another stock buyback initiative amounting to roughly $5.6 billion by TD Bank. These actions indicate a robust confidence among financial institutions, suggesting that they see value in consolidating their holdings and returning capital to shareholders. It's a strategy that speaks to the broader sentiment in the finance sector, a blend of risk mitigation and growth with a dash of pragmatism. After all, in the world of high finance, sometimes you just have to know when to hold on tight and when to let the good times roll by distributing value back to your investors.
Now, if you're thinking about mergers and acquisitions, we're not done yet. In the ever-dynamic tech and industrial sector news, NXP Semiconductors has announced its plans to acquire Kinara for roughly $307 million. This acquisition is a strategic play that underscores the importance of cutting-edge technology and increased capacity in a fiercely competitive global semiconductor market. For those keeping score at home, this deal could potentially speed up innovation and consolidate market power in sectors that are increasingly critical to everything from consumer gadgets to advanced industrial applications. And while mergers and acquisitions might sometimes feel like corporate chess moves, there's no doubt that the outcome of these strategies could be very telling for the tech industry at large.
Switching gears to another major acquisition announcement, Hyatt Hotels has declared its intent to acquire resort operator Playa in a deal valued at nearly $2.6 billion. This move is a clear indication that even in uncertain times, the travel and hospitality sector remains brilliant, banking on the promise of consumer spending and robust recovery in leisure activities. Considering that the pandemic-era slowdown has largely receded in many parts of the world, this deal might be seen as a forward-looking bet on the revival of global tourism and hospitality. It's an exciting development that will undoubtedly have ripple effects across the service industries, particularly in regions that rely heavily on tourism revenues.
And then there's the fascinating conversation surrounding the price of gold. A notable market analyst has boldly predicted that gold could well hit the magical figure of $3,000 soon, and even push its way to $4,000 by the year 2026. This forecast is based on a mix of factors ranging from inflation concerns to the tariff actions and a broader geopolitical environment. The underlying narrative here is that countries worldwide are increasingly viewing gold as a safe haven, especially in a world racked by uncertainties ranging from economic policy shifts to the rise of digital currencies. For those with an eye on precious metals, these insights are a reminder that sometimes the old adage, savings in gold keep worry at bay, might hold more weight today than ever before.
While we're on the topic of markets that might not always be the center of attention but hold intriguing potential, there's been a growing buzz around some cheap European stock markets. According to one of the emerging reports, diversifying into European equities might offer better returns than sticking with the usual picks. It's a refreshing reminder that value can often be found off the beaten path, and that the international landscape is ripe with opportunities that sometimes escape the usual radar of the average investor. Whether it's a contrarian move or simply a smart play, it's an area that certainly demands a closer look as market conditions evolve.
Not to leave any stone unturned, another corporate development hitting the headlines is from Emerson. The company has recently confirmed a final offer of $265 per share for Aspen Technology, which they are touting as their best and final price. This move, while straightforward on the surface, underscores the competitive nature of corporate negotiations and the increasing pressure to deliver value both to shareholders and to the broader market. It's a classic example of how corporate strategies adapt rapidly in a high-stakes environment.
Now let's bring this conversation back to the overall market trends. We're witnessing a multifaceted market today. On one hand, the indices and major tech and digital assets like Bitcoin and Ethereum are reflecting stable, if not slightly upward trends, suggesting that investor sentiment remains buoyant. On the other hand, the nuances of tariff news and macroeconomic policy discussions hint at the underlying volatility and the cautious optimism that seems to pervade across various sectors. One of the prevailing themes this morning is a blend of recalibration and anticipation, a sense that while uncertainty exists, there's a ready appetite for growth and an understanding that sometimes risk is the price of progress.
Let's dig a bit deeper into how different sectors are responding to these dynamics. In the technology sector, acquisitions like NXP Semiconductors' move to acquire Kinara highlight the ongoing commitment to innovation. We're in an era where technological advancements are not just incremental but exponential. Think about it. Every time you upgrade your smartphone behind the scenes, there's a symphony of strategic decisions and acquisitions that fuel that progress. And while technology stocks can sometimes be volatile due to rapid changes in investor sentiment, the underlying fundamentals, like the drive for efficiency and enhanced capabilities, remain strong. It's all about balancing the scales between cutting-edge innovation and maintaining a steady course in a fluctuating market.
Meanwhile, the energy sector continues to be a mixed bag. Global demand is rising and supply dynamics are ever shifting, reflecting both the geopolitical tensions and the push for renewable energy sources. We have companies that are adapting quickly to this environment by diversifying their energy portfolios, investing not just in fossil fuel projects but also in renewables. This shift mirrors broader global trends, where the imperative to balance economic growth with sustainability has taken center stage. It certainly reminds me of the classic joke, why did the oil executive start a band? Because he always had the right pitch for renewable energy. Okay, maybe that one was a bit off the wall, but it does illustrate how even the most serious sectors can appreciate a lighter moment amid the complexity.
In the financial sector, the story of Schwab and TD Bank is particularly noteworthy. The stock buybacks and stake sales are indicative of a sector that is not only confident in its own performance, but also keen to drive capital efficiency. Investors should be paying close attention here, as these moves often act as leading indicators of broader market confidence. When major players in finance decide to optimize their capital structures through buybacks, it sends a message that they have a clear vision for future growth and a strong commitment to shareholder value. It invites us to ask, are we simply reacting to short-term news, or is there a deeper structural confidence that will carry us through turbulent times? It's a question worth mulling over during your morning coffee or while combing through your portfolio.
Our conversation about global market implications wouldn't be complete without touching on the international dynamics. In recent times, the global stage has experienced shifts that are more pronounced than ever before. With tariffs and trade policies being at the forefront of policy debates, we're witnessing a recalibration of global supply chains. This is particularly significant for countries that heavily rely on exports of aluminum, steel, and other industrial goods. Traditional trading partners might reconsider their strategies, and we could see the emergence of new alliances and shifting power balances in global commerce. For investors, this is a reminder that the local performance of indices is often intertwined with international developments. When one country makes a bold market move, ripples are felt across borders, prompting a more holistic view of risk and opportunity.
What does this mean for you as an investor or trader? It's essential to maintain a diversified portfolio that not only bets on domestic strengths but also leverages emerging international opportunities. It may be time to ask yourself, am I too concentrated in one market, or is it time to explore those undervalued European equities that could provide better returns? The diversification approach could mean the difference between riding a single wave and enjoying a whole ocean's worth of opportunities.
Let's now take a moment to dive into some expert insights and predictions. Many market strategists are looking at the interplay between tariffs and global trade policies as an ongoing source of volatility and potential opportunity. Some argue that while tariffs could lead to higher input costs in the short term, they might ultimately drive domestic industries to innovate and become more competitive in the global arena. On the flip side, critics say protectionist measures could lead to trade wars, reduced market efficiencies, and longer-term economic stagnation. The experts are divided, and that's where you, the savvy investor, come in. Are you prepared to take on the risk, or do you see these moves as a necessary step toward rebalancing an overextended trade ecosystem?
Additionally, with predictions about gold soaring to levels we haven't seen in decades, there's an increasing narrative that suggests traditional safe havens may once again become critical components of a balanced portfolio. With inflation and geopolitical uncertainties casting long shadows over financial markets, gold's luster remains undiminished in the eyes of many investors. But here's a thought-provoking question. In an era where digital assets like Bitcoin and Ethereum are pulling in record numbers, can gold truly maintain its status as the ultimate safe haven? Or are we witnessing the dawn of a new gold standard, one that's dollarized and digitized, where the old guard meets the new? It's an intriguing puzzle for our times.
In the realm of consumer sentiment, there is also growing interest in retail markets. With the easing of pandemic restrictions and a resurgence in travel and leisure spending, businesses in the hospitality sector have much to celebrate. Hyatt Hotels, with its significant acquisition move, is clearly betting on the revival of consumer confidence and spending power in travel and leisure. In a way, this acquisition is like a well-timed dinner invitation where all the guests are guaranteed to have a memorable evening. It's both a signal of recovery and a promise of even better days ahead.
So as we circle back to the overarching themes of today's conversation, it's important to reiterate that we're in a period of cautious optimism. The major indices are showing modest gains, individual sectors are making strategic moves, and global dynamics are gently but surely pushing markets in new directions. While the humor in these intricate financial maneuvers might not always evoke belly laughs, it certainly provides some levity in an otherwise data-heavy world.
Now, how do we wrap all these variables together into a cohesive strategy? One approach is to keep an open mind and diversify your thinking just as much as you diversify your portfolio. Embrace the volatility as an engine for opportunity rather than simply a source of stress. I always say that if the markets were a dinner party, sometimes you'd rather be the one stirring the sauce than the one getting caught in a spat. As you go about your day, keep asking yourself, what opportunities lie hidden in these challenges? Where can I find that edge that others might overlook? These are the questions that can ultimately define our approach to evolving market conditions.
Let's break down some sector-specific insights. In technology, as we mentioned earlier, the continuous influx of acquisitions and strategic investments is painting a picture of relentless innovation. Tech companies remain at the forefront of growth, and even as valuations fluctuate, the long-term trajectory often points upward. It might be useful to consider whether the current valuation metrics are reflecting the true innovative potential lying just beneath the surface. With rapid developments in areas like artificial intelligence, cloud computing, and semiconductor technology, there's a wealth of opportunity if one knows where to look. The question for many of you might be, is it time to re-examine your tech holdings in light of these strategic moves and technological breakthroughs?
In energy, we are seeing a dynamic interplay between traditional fossil fuels and the surge in renewable energy investments. The push towards greener energy is as much about corporate responsibility as it is about future profitability. Companies that manage to blend established energy sources with renewables are positioning themselves at a distinct advantage. This hybrid strategy can help mitigate some of the environmental and regulatory risks while taking full advantage of the long-term trends towards sustainability. For those curious about making strategic picks in this sector, consider companies that are making aggressive investments in renewables while also maintaining robust earnings from traditional energy operations. It's a fascinating balancing act that could very well redefine future energy landscapes.
Turning our attention to the financial sector once again, there's a lot to unpack from the reshuffling of stakes and the strategies of institutions like Schwab and TD Bank. These developments remind us that sometimes the best way to reduce risk is to double down on what you know best. When companies return capital to shareholders through buybacks or optimize their shareholding structures, it often reflects a deep-seated confidence in their future performance. It might be worthwhile to explore how such strategic moves could impact long-term value creation for investors who are looking to ride out any short-term market fluctuations. After all, sometimes the signal from inside the boardroom can offer a glimpse into the broader future of an industry.
And while we're deep into the specifics of sectors and trends, let's not forget the global implications of these moves. The tariffs, trade policy shifts, and the ripple effects of major acquisitions create a mosaic of factors that extend far beyond our domestic markets. Global supply chains are being re-engineered, alliances are being redrawn, and emerging markets are asserting themselves in new ways. For instance, if tariffs lead to a rebalancing of trade flows, we might see countries that were previously considered peripheral to global trade suddenly taking center stage. Investors winning in the international arena will be those who can read these signals early and understand that the world market is an interconnected web where one tug in Shanghai might very well ripple into Berlin or New York.
Finally, let's take a moment to appreciate this human element in all of this, something that is sometimes lost in the whirlwind of numbers and news headlines. Markets at their core are a reflection of the human psyche, the dreams, the fears, and the relentless pursuit of opportunity. In the bustle of daily trading, remember that each data point represents decisions made by human beings, with all the imperfections and brilliance that entails. So as you review these market trends and corporate strategies, take a moment to ponder, how much do our collective emotions shape the trajectory of these markets? And more importantly, are you ready to harness that insight and turn it into a competitive edge?
Before we wrap up, let's revisit some of the key takeaways from today's discussion. We've seen that major U.S. indices are showing solid but measured gains, reflecting a balanced sentiment amid ongoing policy shifts such as President Trump's tariff plans. The technology and semiconductor sectors continue to push boundaries with strategic acquisitions like NXP Semiconductors' move to acquire Kinara. Meanwhile, the financial sector is busy recalibrating through significant buyback programs and stake sales, signaling strong confidence in long-term growth prospects. In hospitality and travel, Hyatt Hotels' bid for Playa showcases the sector's readiness for a robust recovery in consumer spending. And let's not forget the perennial allure of gold as it braces for a potential meteoric rise, juxtaposed against the burgeoning world of digital currencies.
It's a lot to take in, and of course, as with all market conditions, the situation is dynamic and ever-changing, and that's where you come in as investors and traders. Your ability to process, adapt, and strategize in real time makes all the difference. I encourage you to mull over these developments. Ask yourself, which sectors resonate with my investment philosophy? Am I willing to explore opportunities beyond the familiar territory of domestic equities? How can I better position myself in an environment where policy news and global dynamics are just as influential as earnings reports and technical analysis?
As we draw our conversation to a close today, remember that every decision you make, every shift in your portfolio, and every bit of market insight you gather is part of a larger journey, a journey to not only navigate, but to thrive in these rapidly evolving financial landscapes. And while the markets may occasionally remind us of the unpredictability of life itself, rest assured that with careful analysis and a balanced outlook, you can turn these challenges into opportunities.
I want to extend a heartfelt thank you to all of you tuning in this morning. Your engagement, your inquisitiveness, and your willingness to learn something new every day are what make this briefing so rewarding to host. A special shout-out goes to Pantheon AI, your trusted information co-pilot, for consistently bringing you the insights that empower your financial decisions.
Before I sign off, let me leave you with a few thought-provoking questions. How might the current tariff discussions influence the long-term competitive landscape within heavy industries? Are they hidden opportunities in international markets that could offer a counterbalance to domestic volatility? And in a world where digital currencies are gaining traction, could the old guard of precious metals truly hold their ground as the ultimate safe haven? Reflect on these questions as you navigate your day, and consider them when formulating your strategies for future market moves.
Thank you once again for joining me on this journey through today's financial landscape. Don't forget that you can always reach out to our AI co-pilot with your questions and insights, and we'll be back tomorrow with another deep dive into the markets. Remember, learning shouldn't feel like a full-time job. Have a great day and happy investing.